This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 8, 2026, and this is the New York pre-market. Now, let's get into it. The Nasdaq 100 has shattered its immediate consolidation, dropping minus 1.85% to $709.43, and pressing hard against the critical June 30 low of $702.81. While the broader S&P 500 holds relatively steady at $747.71. The fracture is visible in the sector split. Technology is bleeding, while energy and healthcare attract fresh capital. We are looking at a market where leadership is fracturing faster than breadth can repair itself. As we head into the session, the calendar highlights Delta Airlines reporting quarterly results on July 9th with an estimated earnings per share of $1.49. Given the current macro backdrop, real GDP slowing to 2.9% and non-farm payrolls cooling to just plus 57K, this report serves as a direct proxy for consumer resilience. If Delta misses or offers cautious guidance, it confirms that disposable income is tightening under the weight of sticky inflation.
That's the litmus test. With core PCE stuck at 3.41%, the Fed is unlikely to ease policy, meaning Delta's ability to maintain margins without passing costs entirely to consumers will dictate whether we see continued consumer weakness or a stabilization in discretionary spend.
The data paints a picture of defensive rotation. The Russell 2000, IWM, is down minus 0.91% to $296.19, testing its July 2 low of $294.98, while the Nasdaq-led QQQ suffers a minus 1.85% pullback. Meanwhile, the energy sector, is surging plus 2.84%, and the healthcare sector, is up plus 1.53%. The VIX sits at a suppressed 15.57, suggesting that despite the tech drawdown, overall volatility expectations remain low, a dynamic that often precedes sharper expansions if support levels fail. Let's look at the movers driving pre-market volume. Alibaba is gapping up plus 9.5%, a massive outlier in a sea of red for big tech. Conversely, Rivian is down minus 4.8%, reflecting continued pressure on electric vehicle demand. And Sunrun is up plus 5.3% following news of a distributed AI data center pilot. The Alibaba surge is fascinating because it defies the broader sector sentiment. While NVDA sentiment is neutral at plus 0.12 across 58 articles, BABA is showing extreme bullish momentum. It suggests retail and funds aren't abandoning tech. They are abandoning US-centric AI hardware speculation and rotating into undervalued, cash-rich platforms like Google, which holds a plus 0.64 sentiment score.
But be careful interpreting that as a sector-wide reprieve. BABA is a single-name liquidity event. Look at the structure. The technology sector is down minus 2.39% today and minus 3.36% for the week. You cannot argue for a healthy tech sector when the primary ETF is in a clear downtrend. BABA Rise is an island in a sinking fleet.
The real risk flag here isn't BABA. It's the divergence between QQQ and SPY. QQQ is down nearly 2%, while SPY is barely touching minus 0.48%. That tells me the pain is concentrated in high beta growth. If small caps like IWM start breaking below $295, that credit stress will spill back into the QQQ, dragging those safe mega caps down with them.
Let's drill into the breakdown. QQQ is at $709.43, having lost the upper half of its 10-day range. Grid, walk us through the technical structure here.
The chart is ugly. QQQ traded at $709.43, sitting just above the absolute floor of $702.81, which marked the June 30 low. The 10-day range was $702.81 to $737.62. We are currently testing the lower boundary. If price closes below $702.81, we trigger a deeper correction structure, likely exposing the $700 psychological handle. The volume profile on the decline into the technology sector, minus 2.39%, confirms this isn't noise, it's institutional redistribution.
It's not just technical distribution, it's a fundamental repricing. Core PCE is at 3.41%, and the 10-year, 2-year yield curve is flat at plus 0.36 pp. That flat curve destroys the valuation model for long-duration assets like QQQ. Investors are refusing to hold these multiples when the cost of capital is effectively frozen at 3.63%. This is a multiple compression event, not just a profit take.
And the sentiment data backs the multiple compression theory. NVDA is stuck at plus 0.12 sentiment. The AI narrative is cooling. Capital is fleeing unproven growth stories for established cash flows. Look at Google and Goog. They both hold plus 0.64 sentiment. The market isn't leaving tech. It's leaving speculative tech. It's rotating into platform businesses with pricing power.
Here is the danger signal. The VIX is at 15.57. That number is lying. It reflects complacency from before this drop. Options pricing has underestimated the probability of a breakdown below $702.81. If QQQ pierces that level and the VIX doesn't immediately expand past 17, you will see accelerated downside velocity because nobody is hedged. The lack of put buying means there's no catch.
Exactly, and notice the relative strength. The energy sector is up plus 2.84%. When energy leads while tech bleeds, it's usually a sign that bond vigilantes are waking up. The yield curve flattening benefits banks and energy, but it crushes the discount rate for tech. The technical breakdown in QQQ is a symptom of the macro environment rejecting duration risk.
While QQQ fights for $702, the Russell 2000, IWM, is quietly fading to $296.19. CIPHER, what does the fundamentals layer say about small caps right now?
Small caps are the canary in the coal mine for credit stress. IWM is at $296.19, hovering near the July 2 low of $294.98. These companies rely heavily on refinancing cycles. With the Fed funds rate at 3.63% and unemployment ticking to 4.2%, their debt servicing costs are rising while revenue growth stalls. They are being squeezed from both sides, higher rates and softer demand.
Technically, the IWM structure mirrors the QQQ weakness but with less liquidity. At $296.19, we are testing the $294.98 support. A break there opens the door to lower vacuums. Compare this to SPY, which is holding $747.71 comfortably between the July 2 low of $740.03 and the July 6 high of $752.41. Large caps have support, small caps do not. The divergence confirms that this is a liquidity crunch, not a broad recession yet.
I want to highlight the utilities sector, utilities performance. The utilities sector is up plus 0.88% today, though it's down minus 0.7% for the week. Utilities act as bond proxies. When the 10-year yield is 4.48%, utilities become competitive alternatives to treasuries. Money is flowing into the utilities sector and the energy sector because they offer yield and inflation protection. The fact that the financial sector, financials, is up plus 4.34% for the week, despite being down minus 0.16% today, shows that steepener trade is alive. Banks love a steepening curve, even if it's currently flattish. The market is positioning for a future steepening, betting on inflation staying hot.
Right, and look at the sector sentiment. The technology sector is the worst performer at minus 2.39% daily. But communication services is up plus 0.73% daily and plus 2.91% weekly. Again, the bifurcation. Investors are buying the ad-supported giants, Meta, Alphabet, Amazon, because their balance sheets are fortress-like. They are selling the hardware vendors. The sentiment isn't bearish on internet. It's bullish on cash flow, bearish on capex. Let's address the bright spot. The energy sector is up plus 2.84% to $54.64. SPECTER, why is money flowing into energy right now?
Because it's an inflation hedge. Core PCE is 3.41%, CPI is 4.17%. Both are well above the 2% target. When inflation sticks, hard assets outperform financial assets. Furthermore, the trade-weighted dollar has weakened minus 0.46% week over week. A weaker dollar makes energy cheaper for foreign buyers, boosting demand for the energy sector components. Plus, with the yield curve flat at plus 0.36 pp, the opportunity cost of holding non-yielding assets like gold or bonds is rising. Energy pays cash, that's the trade.
And don't ignore the correlation with BABA. BABA is up plus 9.5%. A weaker dollar also boosts emerging market exports. BABA represents a rotation into undervalued cross-border tech. It's a dual benefit, currency tailwinds and valuation repair. But note, this is a rotation, not a broadening. The total market cap of the technology sector is shrinking relative to the energy sector. We are seeing capital migration, not net new inflows into equities.
From a technical standpoint, the energy sector is breaking out of a consolidation pattern. The move to $54.64 is accompanied by strong relative strength against the SPY. While SPY struggles to find traction above $750, the energy sector is pushing through resistance. This is a classic flight to safety chart pattern. However, watch the 24-hour high of $54.64. If it rejects there, it might indicate a short-term top in the hedge, but the trend remains intact.
The sentiment around energy isn't just defensive, it's proactive. The news flow is filled with supply constraints and geopolitical tension, referencing the Riven drop linked to geopolitical risks. When headlines scream supply shock, money runs to oil. It's the oldest playbook in the book. The fear of missing out on an energy rally is outweighing the fear of a tech crash. So, to summarize the interplay, tech is getting crushed by duration risk and cooling sentiment, while energy and communication services are absorbing that capital due to inflation hedging and cash flow security.
Let's tie the threads together. Grid identified the mechanical break in QQQ below $709, pointing to $702.81 as the next major test. CIPHER explained why it's happening. The flat yield curve, plus 0.36 pp, and sticky PCE, 3.41%, are forcing a repricing of long-duration assets. Pulse added that this isn't a rejection of all tech, but a bifurcation. Capital is moving from hardware NVDA neutral to platforms Google/BABA bullish. SPECTER warned that the suppressed VIX, 15.57, masks the risk of an unhedged cascade if $702.81 fails. The consensus is clear. The era of easy money for speculative growth is paused. We are in a regime of selective defense.
Key takeaways for the session. First, QQQ is testing critical support at $702.81. A break here accelerates the correction. Second, the rotation into the energy sector and the healthcare sector is driven by macro rigidity. Core PCE at 3.41% keeps the Fed hawkish. Third, BABA surge is a localized rotation play, not a sector-wide rescue. Tomorrow, watch Delta Airlines guidance to see if consumer demand holds up. This has been the ShadowQuant Equities edition. Stay disciplined, manage your risk, and trade the data. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.